Hi, my name is Lisa Wurzbacher with Liqui-Grow, and today I am here with Bill Dahl, Senior Partner at Reiser Jennings, and we are going to talk all things tax planning. Bill, tell us a little bit about yourself.
I've been with Reiser Jennings since 1979. I'm a CPA and a member of the American Institute of CPAs, the Iowa Society, and the Illinois Society. And we just do a lot of tax returns.
That's good, because I have a very large list of questions for you today. So I'm going to kick this off and we'll get started. What tax law changes went into effect last year in 2021?
Well, year over year, there has not been a lot of substantial changes with the tax law. The law that we went with last year is the same law we have this year. So everything pretty much is the same. The only things that sort of jump out a little bit are there's some regulations related to COVID and benefiting your employees with COVID. And also there's the retention credit that's still available from, again, COVID, related to COVID. And then there's also PPP, which is, we're sort of on the latter effects of PPP, which is the, I can't think of the term now, but
the paycheck
protection program.
Yeah.
And it's sort of winding down and pretty much is gone.
Okay. Can you elaborate a little bit on the employee retention credit?
The Uncle Sam basically wanted to try to help employers keep their employees during the pandemic. And so what they did was give some free money to businesses where they applied through their banks. And they got some free money, and it allowed them to keep their employees with them instead of letting them go when income dropped off because of the pandemic.
So, Bill, with these tax laws that you're discussing, whether it's employee retention credit or the PPP, is there a minimum headcount requirement to qualify or take advantage of these programs?
No, not really. Basically, they're just wanting you to keep the employees you have. So there is really no minimum employee limitation.
Okay. What about 2022? Anything that we expect to happen, either go into effect or expire in 2022?
In 2022, everything gets indexed, but other than that, the law stays pretty much the same. And until, of course, Congress changes something, because there in the works is the Build Back Better law, which has a tendency, sound like it's done for. It's not going to get passed, but if it does, there's a lot of changes that do go into effect.
When you say everything gets indexed in 2022, what does that mean?
Uncle Sam adjusts all the limitations based on inflation.
Okay.
They go up a couple percent here and there. Use an example like the Section 179, which is unlimited write-off of equipment purchased in a year, goes from $1 million to $1,050,000.
Okay. Okay. Makes sense. So is there anything else regarding tax law that might be expiring either this year or in the next couple years that we should be keeping an eye on?
Probably the biggest change is back in about 2 or 3 years ago, they passed a law change that went into effect immediately, but expires, which we call sunsets in the accounting world, in 2026, 2025, and then in 2026 it goes back to the old law because due to budget reasons they couldn't make it permanent. So in 2026 we go back to a law that was based on 2022, and that could happen really quickly. And probably the biggest change that does come into effect is the unified credit for estate taxes, which right now is $12 million in 2022, is $12,060,000, will go back to something in the range of $5.6 million adjusted for inflation.
Okay. So can you elaborate on that a little bit for our viewers? When you say the unified tax credit limits are going to change from 12 million down to 5 million, what are you specifically talking about?
Well, for estate taxes, when somebody passes away, of course, they add up all your assets, and that comes up to a number, whatever that is. for farmers, the biggest asset is farmland. And that farmland is valued and gets you to a big number really quick. And then they subtract off the unified credit. And the
Okay.
unified credit is right now $12,060,000. And if you still have a number there, they tax it at roughly 40%.
Okay.
And that's the one that basically reverts back to in the $5 million range in 2026,
Okay, that's a big difference.
unless they change the law, of course.
Okay, okay. So Bill, the tax law that's going to expire or could potentially expire in 2026, anything else besides the unified tax credit that we should be keeping our eye on?
Probably the biggest thing for farmers is, just like any business, is buying equipment is a big cost for them. And there's two things that allow you to write off equipment. One called Section 179, which allows immediate first-year write-off of roughly $1 million. And the other one is bonus depreciation, which allows you to buy equipment and write it all off immediately. Both sort of do the same thing, but the bonus depreciation starts to go away next year. It's only worth 80%, then it goes to 60, then to 40, then to 20, and it's gone. Of course, unless they change the tax law. Everything I say is based on unless they change the tax law. The other one is Section 179, which stays around. But Section 179 is one of those things where it has the immediate write-off of $1 million of equipment, which starts to phase out on how much you can write off based on how much equipment you buy. It probably will start to go away because Congress always brings us in when they need to help the economy, and then all of a sudden it's gone. So
Okay.
right now it's not planned to go, but probably in the future it will go away based on tax law change.
Okay, especially if the economy starts to
To recover.
improve. Okay. Can you talk through a little bit the difference between Section 179 and bonus depreciation, when you would use one and when you would use the other?
You flip a coin, okay? Bottom line is they both do the same thing. They allow you
Okay.
to write off the equipment. Section 179, which again is limited to $1,050,000 in 2022, can only take your business, your profit, the farm profit, down to zero.
Okay.
It cannot create a negative.
Okay.
Where bonus depreciation can actually be written off and create a negative. Why do we care about negatives? Basically, you're allowed to carry net operating losses, and the negative, back to a couple years ago. And that's beneficial if you paid a bunch of taxes a couple years ago. So
Okay.
that's probably the two big differences between Section 179 and bonus, other than the fact that bonus does start to phase out.
Okay. But what you're saying is you're picking one program or the other.
Yes.
Okay.
And in theory, you really don't even do it. Your accountant does it and takes the best
Okay.
tool, the best useful tool which works for you when they're doing their tax return.
Okay.
As a general rule, bonus depreciation was the most used asset. The only problem with bonus depreciation in Iowa didn't let you to take bonus depreciation.
Okay.
But they have phased that back in, and now you're allowed to take bonus depreciation and you're allowed to take Section 179 fully in Iowa.
Okay.
But over the last couple of years, that has not been true.
Okay. And so when you say that those percentages are starting to reduce from
Phase out is
80
what
to
I call
60, yeah, phase out. Okay. Just technically speaking, what exactly does that mean?
That means that right now, for bonus depreciation, I can write off 100% of a $500,000 combine. I could write it all in my decision. I could write it all off, take half it off, or whatever I want to do.
Okay.
Okay, it was using Section 179 also. And, but in the future, I'm only going to be able to do 80% of that, and then it goes to 60, and then 40. Every year it drops 20%. And I can't remember what year that's going to be, but it's going to be gone at some point.
Okay.
And I don't see it coming back. I mean, because Section 179 does the same thing.
Right.
And so I just don't see it coming back once it's gone.
Okay. Okay. Thank you. That's really good information for our viewers. Let's switch gears and talk a little bit about PPP. Are there any lingering effects or tasks that need to be completed for people who participated in any wave of the PPP program?
Well, trying to put it simply, the Paycheck Protection Program is now gone. Working through your bank, you could go get a loan from the government. It's called a loan, And this money you could get based on parameters that the Uncle Sam calculated, and you get this loan. You could then apply to get the loan forgiven so you don't have to pay it back. As a general rule, because of the drop in income of the pandemic, it was very easy to get the loan and very easy to get it forgiven. Okay, so in theory, once it's, the only thing left is if you still have that PPP loan, you need to provide the information to be able to get it forgiven. And that pretty much is the end. That, in 2021, that's all going to be gone now.
Okay, okay. And what about the CFAP, the government program payments? What's happening with those?
Well, government program payments come year after year, and they're different. They're called different things.
Okay.
The negative government program payment is it's taxable income to you. Okay, so if you get it, it's taxable income, and you have to pay taxes, and Uncle Sam usually gets 30% of your money for taxes. Where PPP, the big factor on PPP was it was not taxable.
Right.
And it didn't eliminate your deduction, which means it was free.
Right.
And that's the benefit of the PPP loan over government payments, which are taxable. In addition, there's the employee retention credit, which you might be able to apply for and get the benefit of. All this information, you got to talk to your own CPAs and your own accountants. But bottom line is the employee retention credit, I would call taxable, but the IRS calls it as the wages you use to apply to get the employee retention credit, you don't get to deduct those wages. So therefore, since you don't get to deduct them, it's like being taxable.
Okay. And if we have growers watching right now that have 1 or 2 employees, that could still apply to them.
Yeah, basically their accountants might be able to get it in the 2021 return.
That's great. I want to switch gears now to tax planning. What are 2 to 3 things that you recommend to your clients at the start of each year?
Well, probably the biggest thing for a farmer in planning is when they get close to the end of the year, they got to meet with their accountants and their CPAs and talk about where they think they're at. And that means they have to have an understanding of where they're at and if they have a big income. Keep in mind, taxes, if I come down to a profit on my farm return, as a simplest possibility is I'm going to probably owe 15% income tax. That goes up, of course, as your income goes up. And I also, a big one is 15.3% Social Security tax.
Okay.
So in theory, on any dollar profit I'm going to make, I'm going to lose 30% of taxes.
Okay.
And as a general rule, we don't have a lot of cash to pay those taxes, and we don't want to pay them, so we buy equipment. And the other big one is we prepay expenses at the end of the year.
Okay.
We buy seed, we buy fertilizer and chemicals and things like that, and we get them bought. We get the input to our next year's farming bought before December 31st.
Okay.
And that delays the taxation to a future year. Keep in mind, it only delays the taxation, but it solves the problem today, and it makes next year a problem. So that's probably one of the biggest planning things a farmer needs to do. But to be able to do that, they have to know where they're at the end of the year, and probably December, and they have to meet with their accounts to see what they need to do before year end. So they don't owe that immediate 30% tax, which could go up to almost 50% tax.
And are there things that they can do throughout the year, tracking metrics, bookkeeping, that makes tax prep easier and less time consuming for them at the end of the year?
Keeping good records is the only way that you can run if you're running a business, you should plan on keeping good records. And that means keeping track of those receipts and those trips and those things that you're doing that are deductible. And you have to come up with a system, working through your accountant, and come up with a system to keep track of that information. Yes, that's very important.
Okay, good. So when it comes to preparing for taxes and doing good bookkeeping, there are a lot of different software programs that people can use to stay organized. What's the software program that you recommend the most?
There's a lot of simple programs out there, but probably the one we see the most is QuickBooks.
Okay.
And QuickBooks is we call a double entry system, and it keeps track of your expenses and your balance in your bank accounts and all that kind of stuff. But QuickBooks is, the way to think of it is a checkbook. You just fill out a checkbook just like you're writing a check, and The only key to it is you code the expense you're paying into an account. And that basically helps you keep track of your records so that you can tell it a parameter from January 1 to December 31st, you come up with a balance sheet or an income statement that's going to help you in that. And the only key to it is keep that up currently. Don't wait till the end of the year,
Right.
because if you wait till the end of the year, it's just hard to do. You forget a lot of things, and you forget what you did when you've spent that number, and you don't keep track of your expenses as well. So try to do it every week or every month. Get everything caught up.
Okay. And when it comes to tax planning and having tax planning meetings with our accountants, is this something we should just do at the end of the year in early December? Should we be having quarterly meetings, biannual meetings? How frequently as a grower should we be checking in with our accountants?
Probably, I would say for a farmer, it's best at least 1 time to 2 times a year.
Okay.
Probably right after growing season, and always have one right before December when you know what your profit's going to be.
Okay.
And try to figure out what that's going to be, and you can maybe plan and prepay some of those expenses and get things caught up.
Okay, so let's talk about some common mistakes that you see. What mistakes do you see made in small businesses, whether it's just general small business or ag-related businesses?
Well, probably back to what we just talked about. The biggest mistake is not keeping your records timely. Inevitably, if you wait till December 31st, you forgot about the first half of the year. And if you just forget about stuff. You buy that piece of equipment, if you don't keep track of a check register that keeps track of your equipment, all your checks, you might not remember that you bought that piece of equipment back in January, and we miss it. And then we have to go back and amend the return because we missed not writing it off. So really, good record keeping is the most important, and the things that most mistakes are made from.
Okay, good. What about write-offs? I mean, we all want to write off as much as we possibly can. What are some write-offs that you see turned in that probably don't really qualify?
Well, basically, meals and entertainment. The keyword entertainment is not deductible at all anymore.
Okay.
And having a boat, not deductible at all anymore.
Okay.
But meals used to be 50% deductible, and because of the pandemic, they changed the law. Now meals, when you go out and have your meetings related to planning related to your business, and you go out to dinner and talk about it, that's deductible, 100% again, at least for this year and last year. That goes away, and then meals and entertainment will no longer be deductible. So meals is just a reprieve because of the pandemic. And if meals make deduct, one key on the meals is it's got to be at a restaurant. Don't ask me why Uncle Sam did that,
Okay.
but they were trying to get people to go to restaurants, and that's probably where we're at.
But you're saying at the end of this year, deducting meals is going away?
In 2021, it's fully deductible. In
Okay.
2020, it was fully deductible.
Okay.
2022, it goes away again, and I think it passes back to 0% deductibility.
Okay. What about travel? Some of our growers have second homes or travel, vacation, not necessarily vacation, but if they have to go to a conference, hotel, stuff like that.
When you threw second home in there, you made it too encompassing.
Okay.
Bottom line is, yeah, I can travel for my business. I can go to Florida, and as long as I keep good records and have directors meetings and meetings related to my farm in Florida, it's deductible, the trip down.
Okay.
Now, if I stay 2 weeks, I really don't get to deduct the 2 weeks of hotel.
Okay.
I probably only should be able to deduct a couple days of that.
Okay.
But the plane flight down and back is going to be fully deductible. As long as you keep track of records related to what you discussed and have
Okay.
actual meetings where you discuss it. And that's the same way with any place. Now, if you go overseas, it becomes a whole different animal. But if you keep it in the United States, yes, it's deductible.
Okay.
Just like going any place. It doesn't matter. You go to Des Moines for a meeting, fully deductible. If you go to a seminar in Des Moines or go to a show in Des Moines that's related to farming, fully deductible. Anything you spend is fully deductible. Again, if you stay in Des Moines for 2 weeks, it's not fully deductible on the hotel stay. A couple nights would be good, but all that would be deductible. Anytime you go any place, anything you do for business, if you just keep track of it that way, anything I do for business is deductible someplace.
Okay. Another question related to deductions. You mentioned record keeping. Okay, so I'm going to have receipts, Let's talk about invoices I may receive. How do you keep the paper in addition to having things documented electronically? And then how long, over what period of time are we keeping these records and storing them and filing them?
A dangerous question.
Okay.
Bottom line is I'm big on keeping my equipment a long time. I
Okay.
buy a combine and I bought it 10 years ago.
Okay,
I need that receipt. So if I tell you it's 6 years, 3 years, I still need the receipt for that combine that I bought 10 years ago.
okay,
But as a general rule, the statute of limitations is 3 years with the Internal Revenue Service.
okay,
That means they can't get to anything after 3 years, and you can't change anything after 3 years. It also, because you can have losses that can be carried back, it could be thrown into another 3 years. So the end result is our usual answer to that is 6 years. Keep 6 years of
Okay.
records, receipts, and everything. Now, if you scan your receipts into a computer, you don't need the receipt. You just
Okay.
you can scan into a computer. Uncle Sam and the Internal Revenue Service accepts scanned documents.
Okay.
It's just, you should keep it about 6 years. But again, that one question, if I buy that piece of equipment a long time ago and they want to see it, you need to be able to provide an invoice that for something bought 10 years ago.
okay. And you said because losses can be carried back. Can you just make a few comments about that?
Talk to your CPAs and accountants about this, but bottom line is, in 2019 and 18, the law changed due to the pandemic. You're allowed to carry back losses 5 years.
Okay.
But that was 2020, that ended. Now we're back to 2021. Now I'm only allowed to carry it back 2 years.
Okay.
Farmers can carry back losses 2 years. And that's the way the law is right now. Losses and any credits that I could have claimed, it can go back 2 years. But if I'm looking back to a loss that I had in 20 and your accountant didn't carry it back, it is possible to carry that 20 tax return loss back 5 years
Okay.
and get a refund
Okay.
if you had taxes due in those other years.
Okay, so if I had a good year last year, but a big loss this year, you can carry
You
some
can
of
carry
that
it back
loss
and go get it. That's correct.
Okay, good. What tax law is unique and specific just to ag?
Oh, there's a lot of elections that is specific just to ag.
Okay,
Use an example, crop insurance proceeds. If, based on your history of doing stuff, you can actually, if you get a big crop insurance because something really damaged your crop this year,
Okay.
you can actually elect to carry that to the future, to another year, to next year. Not more than 1 year, but you can not claim it this year and carry it next year.
Okay.
Then, of course, next year you got to claim it, and it could double up your income because you did that. So you got to watch that.
Okay.
Another one is if you had to get rid of cattle or something like that related to drought or a catastrophe, you're allowed to make elections that allow you to claim that income back in another year, which usually is next year. There's little elections like that that farmers have and nobody else really has.
okay. But if I was gonna make a big crop insurance claim, and I knew that the next year I had slated to buy some equipment, I could carry that
You
forward?
could carry that forward and tax it next year.
Okay.
Yes.
Okay, good. What changes will there be to Iowa income tax law in 2022 and going forward?
The governor came out the other day and was talking about a 4% tax rate. That's just talk, okay?
Okay.
But right now, our tax law is changing in Iowa, and in 2022, it's still the same.
Okay,
We're allowed to deduct federal taxes as a deduction, okay? Starting in 2023, federal taxes are no longer deductible.
okay,
In 2022, the maximum tax rate is 8.453% on Iowa. Okay, 8% is a big number. But when federal taxes no longer become deductible, it goes to a flat 6.5%.
okay,
It basically starts low and then goes to 6, the top rate is 6.5%. So in 2023, the top rate's 6.5%, but we don't have federal taxes as a deduction, which is a big change. So do you think that Iowa's going to lose revenue? No, they probably don't lose revenue because those federal taxes as a deduction sort of work out to be around 2% benefit. So if I take my 8.4 less my 2%, I'm at 6.5.
okay,
And what the governor talked about the other day is she wants to get it to 4%.
okay.
I mean, I'm not exactly sure they'll ever get that done, but we are going to be at 6.5%. And when you look across the river to Illinois, they're at 4.95%. So I mean, we're very comparable to Illinois in that situation. So we're not going to be fighting back and forth anymore. Now the big difference, of course, in Illinois is pensions aren't taxable, and in Iowa, pensions are taxable after a $12,000 exclusion for married filing jointly.
Okay. When you say fighting back and forth, as far as like people wanting to live in one state,
Live in one state or the other. I mean, we
Okay.
get questions all the time because, well, if I go to Illinois, is it cheaper? Actually, between the two states, it's probably minimal. I hate to move. I hate to move, but bottom line is I wouldn't move just to get 4.95 compared to 6.5%. I would not.
Okay.
And also, Illinois real estate taxes tend to be a little higher.
Okay.
Sales tax tends to be a little higher, but in Iowa, so they really are very comparable.
Okay. Good segue there. Regarding real estate, we have obviously a lot of our viewers are sitting here. They own farm ground. And any tax law specifically related to real estate or ownership of ground that people need to keep an eye on?
Nothing really has changed in the real estate area. They keep assessing values and assessing based on that. Farmland is assessed at a very low rate, but when it's tied up to a city and the city is expanding that way, all of a sudden that farmland becomes business property and is assessed at a lot higher rate compared to farmland. And that's the only danger. And real estate taxes aren't that bad, but real estate taxes are expensive any way you look at it.
Okay. Okay. What about estate planning and any effects on family farms? You talked a little bit earlier, about some of that tax law, but anything else you want to elaborate on or talk about regarding estate planning?
Probably the biggest thing I want to make sure farmers understand totally, because they should be talking to their lawyers and their estate lawyers and their estate CPAs. And basically the unified credit is $12,050,000. And it's going to drop possibly down to a lower number if the law sunsets.
Right.
And estate law is attacked by the Internal Revenue Service and Uncle Sam all the time.
Okay.
So it's never ending changing. But when you own a little bit of farmland, 200, 300, 500,000 acres, your estates get very big very fast.
Yes.
And when you have a husband and wife and one spouse passes away, basically the $12,050,000 is per spouse. Mm-hmm. So in theory, for a family, that's $24 million and $24,100,000. And that's a big number, but again, farmland makes you get there very fast. If one spouse passes away, you have to make sure there's something called portability. And right now the law, this is made permanent, but everything made permanent can change tomorrow based on a law change.
Right.
And it made permanent portability. And what portability says, if one spouse dies, then whatever they didn't use of their unified credit of $12,050,000 can carry to their spouse.
Okay.
To get that benefit, a 706 has to be filed. Okay, if you don't file a 706, there is no portability. Your state lawyers and the CPAs know that, but sometimes because mom dies or dad dies and most of the income passes directly to the spouse, and everybody knows when it goes directly to the spouse, there's 100%. There's no estate tax anyway, because you get an unlimited benefit going to your spouse.
Right.
The danger is when the spouse dies.
Right.
Okay, and so you just have to watch that to make sure those 706s are filed so that portability does kick in.
Right, because if that spouse lives another 10 years and the value of the land increases,
even goes higher.
Right, then they're going to need that extra.
Yep, and if they get that $24 million because nothing was used on the first spouse's death, that could be a huge benefit when you're talking about farmland valued at $10,000 and $20,000 an acre.
Right. So I have two questions related to the timing of estate planning. The first one is, when should people start? At what age do you typically see people starting that process, or what age do you recommend?
Wills should be started immediately. You should always have a will. And sometimes a lot of farmers don't think of that. Because the main purpose of a will is to tell who's going to take care of my kids in case something happens.
Right.
And there's a big chance working in farming is dangerous. And both spouses could go at one time. You want to make sure that in a will you lay out who you feel should take care of your kids in the future. Okay? And that, by putting it down in writing, that will is very important.
Okay.
And a lot of times people don't think I don't have enough to really worry about it, but just on your kids alone, you should have a will.
Okay.
And then after that, as you grow in value in farmland, owning farmland is really what's going to do it. You need to have a plan, because once you get by that 12 million and 24 million, they take 40% away from you. And that's a big number. And as a general rule, there's not a lot of cash to pay those taxes, so we have to sell farmland to be able to pay the taxes. And nobody wants that.
Right.
I mean, nobody wants a farmer to have to sell his land to pay estate taxes.
Okay.
And so you just have to plan early and plan often related to estate taxes. And that's just talking to your attorneys and making sure that they got you set up right.
Well, that was my second question. So if I've kicked off my estate planning, how often should I be going in to meet with my accountants or my attorney? Once a year, more, less?
Once a year is best,
Okay.
but I say you could do it every couple of years. But the ever-changing world of Uncle Sam and tax law, which could change tomorrow,
Right.
You need to go in, and that could change everything related to your planning. So you need to go in and talk to them.
Okay.
Okay? And I'd say the best is once every year to at least talk to your lawyer that does your estate taxes and say, is there any changes that I should be aware of? So I have an idea of that. Because you don't want to pay that 40 cents on the dollar if you're both gone.
Okay. Bill, thank you so much for being here today. I think this program has been immensely valuable for our growers and our customers. Again, Bill here is with Reiser Jennings, tax accountants. They have 4 locations in the Quad Cities: Moline, Davenport, DeWitt, and Eldridge. So if you're looking for some help with tax planning, I highly recommend them. I am a client myself, and I live in the Iowa City area, so you don't even have to be local to take advantage of their services. Again, this has been really wonderful today, and if you like this programming and you found that it was valuable, please get in touch with us and let us know. We'd like to do more of this in the future if you feel that this type of strategic planning is valuable to your operation. So thanks again.
Thank you
Bill.
very much.
Great
My
to
pleasure.
have you.
Lead Academy.
Liqui-Grow
Excellence.
and agronomy development.